Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter coming to you from sunny Central Florida on a Sunday afternoon. Uh, Pretty decent week for the market in spite of the craziness and sell off on Friday. The market was actually up about a 0.5% on the week. As earlier in the week, the focus was on improving economic news, signs of a spring thaw after the brutal winter weather that put a cap on so many things in both the economy and corporate America. The S&P was up 0.5%. The All World URTH index was up 0.57% in spite of continued issues in the Ukraine. That seems to be fading a little bit. Still a long way to go on that one. Could still have market implications. And the Community Bank Index was really strong last week, up about 1.5% as the fundamentals in that segment of the market just continue to get better. The trade of the decade is working. It's going to continue to work, and these stocks just keep getting better. The big economic news, of course, was the jobs report. The headline number was pretty good, up 192,000. It's one of the better ones in a while. And we're finally back to the 2008 levels of total employed people, and everybody was pretty excited about that. Be sending everybody a report, subscribers, a report by a friend of mine later today that examines the fact that population's actually grown quite a bit since 2008. So reaching the same level of jobs as back then is not quite a big a deal as we might want to make it. That labor force participation rate is still very troubling to me and to lots of other folks that are watching the jobs market, as is the evidence that most of the jobs being created are part-time or lower paying jobs. They're just simply not enough to drive the long-term performance of the economy. We'll see if that changes as we head into the summer. The other big news is we really start to see some of the momentum, the big Momo names, particularly those bubbly little biotechs, started to roll over during the week, and they were giving up ground rather aggressively even before Friday's sell-off. So we'll see if that continues. A lot of these stocks are trading at 150, 200 times earnings, 20 times sales. Those are not easy valuations to sustain. So we'll see what happens there. Now, we did have an interesting discussion around Shane Melvin over the course of the week. It was that age-old value versus growth debate that everybody wants to engage in all the time. I have to tell you, it's one of the dumbest arguments that you can ever get into, and I'll get into that a little bit more here in a second. But this particular argument centered around using the value and the growth indexes, the ETFs and indexes that are tracked, to compare the performance of value and growth. That is absolutely ridiculous. I do not know any value managers who index their portfolio. That value index is going to give the same weighting to a company trading at, say, 70% of book value with tons of debt, failing to meet their interest payments, and on the way into bankruptcy court, as it does a stock with no debt, good earnings, paying a dividend, and trading at 75% of book value. The same thing on the earnings side. You know, a company that's got low quality earnings, lots of accruals, lots of interesting things going on in the balance sheet. Well, if its growth rate's 20%, it's going to have the same weighting in the index as a quality company that's growing at 20%. None of the managers I know in either growth or value index their holdings. To use those as a measurement for a debate is just absolutely silly. You've got to look at actual managers out there in the real world, compare the best to the best, the median to the median, and even the worst to the worst. I've done that. Value still wins. It's a small edge over some of the growth funds over the past few years. Over the long run, the gap actually gets wider. Now, this led us down into a discussion of exactly how do you make money in the stock market over the long run. Now, I am a geek, okay, and I keep up with all of the research papers that come out, and I make it a point to always read views opposite of my own. Over the years, I've come to the conclusion that there's three consistent ways to make money in the stock market. The first, of course, is what I do, deep value investing, finding companies that have a margin of safety and are trading very cheap relative to their asset value and holding them until the value is recognized by the stock market. It's been wildly successful for me over the years, allowed me to maintain a whole string of bad habits and live pretty comfortably down here in Florida. And it's worked for a lot of friends of mine, a lot of great fund managers over the years. So value works. We know that it works. It's been proven academically, in the field, hands-on. Deep value investing works. And what I'm going to say now might surprise you a little bit. The other thing that works when you really dig into the market over the years, you've got the market, the middle ground of the stock market, you've got the deep value. Out here on the other end, you have the earnings growth and price momentum stocks. Guess what? That method does, in fact, work. It beats the market over time. If it didn't, guys like Louis Navellier and Driehaus would not have such enormous, homes and nice lifestyles and be on TV all the time. It does work. It's more hands-on. It's far more volatile than deep value investing, and frankly, value is just better suited to my personality. But on that other edge, the price and earnings momentum stocks do provide a market-beating rate of return. Now, most of these stocks are not the ones you think they are, however. And I know the names that are coming right up on everybody's list. It's the internet stocks, the real popular stocks of the day. Some of them are on the list. A lot of them are not. Rick pulled up a list of earnings growth and momentum stocks this morning. Facebook was on it. Tesla was on it. A lot of the other big names were not on it. And those two, by the way, did not stack up as great earnings growth and price momentum stocks. The leading stocks were things like Spirit Airlines, National Federated Holdings, which is an insurance company, Orchard Tissue, which makes toilet paper basically and sells it down in the southwestern United States in a limited region. Fantastic company, by the way. We bought that when it was a value issue back in 2008. Did really well with it. Firmenite Holdings is one of the leading stocks in this sector, as is Taser and Matrix Services. So it's not the stocks that you think it is when you're talking earnings growth and price momentum. It does work. It's much more hands-on, much more volatile. You have to keep your portfolio diversified. If you try to load up on a few names in that area, you are exposing yourself to a real potential for a permanent loss of capital. I vastly prefer the value approach. As I said, suits my personality a lot better. The margin of safety really raises my sleep level. I'm much more comfortable with it. But I could make you one hell of an argument that to make money in the stock market, you should put half of your money in deep value stocks, the type that we have in the Tim Melvin value portfolios, and half of your money with the very best price and earnings momentum guy that you could find on the planet. That should beat the market. You're going to want to rebalance that every few years. I think 3 years will probably be about the right range for rebalancing the two styles. But I really believe that would give you market beating returns. The research of Cliff Asness, Robert Novi Marks, and some others also shows that it might smooth the overall path as values outperforming at a time when the emerging growth stocks are kind of falling apart, and it might balance each other out. Works academically. I've never tried it in practice, but I suspect it will work extraordinarily well. There's a third way to make money in the stock market, and this is actually the way to get very, very rich in the stock market. And that's using the philosophy of our old friend, Mr. Womack. You simply buy high quality dividend paying stocks when there's a crash. Well, as ridiculous as that sounds, restricting your activity to just severe sell-offs actually provides huge rates of return. Once you stop and think about it, just in my lifetime, I started right around the crash of 87 was pretty early in my career. That was, of course, 25% decline, devastating. In 1993, we had the healthcare reform talk. We were coming out of the S&L crisis. So the pharmaceutical and bank stocks were extraordinarily cheap. 1998 came along. You had the long-term capital and Asian currency crisis related sell-off that gave you a huge buying opportunity. Then, of course, the internet bubble in 2000, 2003, and the most recent credit crisis, that gave you huge opportunities in 2008 and 2009. About every 5 years, Wall Street throws a sale in the overall market. Much more frequently than that in individual sectors that will sell off to absolutely stupid prices. And you can buy quality companies for very low multiples of earnings, cash flow, and assets. You can even often get them at a substantial discount to their underlying asset value. If you had done that, just buying these events, these huge sell-offs, you're never going to catch the bottom, but you can usually get pretty close just by watching the news and waiting for the real panic to set in. You've done pretty well over the last 25 years. In fact, you're disgustingly rich. You own things like Apple at $7 in 2003, BB&T Bank at 12 in 2009, McDonald's at $12 back in 2003, Microsoft and Disney in the mid-teens back in 2008 and 2009. Can go on and on, but you see the point. You can make a lot of money in the stock market by aggressively hoarding cash, maybe doing a few arbitrage situations or special situations over the time, but just aggressively building up cash, waiting for that large decline, either in the overall market or in a specific sector that creates the type of buying opportunity. Can't really call it once in a lifetime because you're probably going to see it 20 to 25 times in your lifetime if you live a nice long life, but it creates an opportunity to buy quality stocks extremely cheap. Does happen. It's happened in the past on a regular basis. I have no reason to believe that it's not going to happen on a regular basis going forward. That's the third and most effective way to make an enormous amount of money in the stock market. We really think that using deep value investing most of the time and taking some money and putting it into the McDonald's and the Disneys and the other, high quality blue chip stocks when there's a severe crash is going to make you the most money over your investing lifetime. Certainly how I've approached the market over the years. It's been pretty kind to me so far. And I just think that's the way to go if you don't want to be hands-on tied to that computer screen, trading a portfolio of earnings growth and price momentum stocks. So anyway, we've got a very busy week coming up. We've got earnings season kicking off, of course, with Alcoa early in the week. The Bank of Japan is having a monetary policy meeting. The Fed minutes are being released. Earnings season, they're looking for a 1.4% decline. As weather has supposedly decimated a lot of folks' business over that last quarter of the year. My major thing to watch during the quarterly silly season, as I call it, is going to be revenue growth. There's been no revenue growth anywhere in this market since 2008. Very curious to see if that's going to change. I don't think it will. I think we're going to have a lot of negative surprises, whether it's just weather or the fact that the economy is not growing at the rate that folks were hoping that it would be by now. I think it's going to be kind of a rocky earnings season. Maybe it'll create some of those great opportunities to buy all those companies on our watch list at 80% of book value or so. So anyway, the wife has taken the young one and her friends off to the movies. Peace and quiet is reigning in the house. The Orioles are getting ready to play the Tigers on the MLB Network. So hopefully we can get our 1-4 start to the season turned around. Next week, we also have the Masters starting on Thursday, while the Orioles will be facing the Yankees and the Blue Jays as they continue to be stuck with AL East teams to start the season. And, of course, the Tigers is just a throw-in, one of the best teams in baseball. Tough to get off to a clean start playing these teams. So, anyway, it's going to be a great week. Should be a wonderful afternoon. This is Tim Melvin with the Tim Melvin Deep Value Letters, and I will talk to you guys next week.